on this jam-packed edition of Money Life.
We're generally fans of gold in pretty much across all our portfolios. And it's, again, this is one now where it's not inconceivable that, within the next half a decade, gold could be sitting closer to $10,000 an ounce versus where it is today.
That's Ben McMillan, Chief Investment Officer at IDX Advisors. And in the big interview, he not only talks about gold's potential to hit 10,000, he also talks about how the Fed at some point will have to adjust and just start accepting inflation at 3%. But up first today, Amanda Agati, Chief Investment Officer at PNC Asset Management Group, here discussing their PNC Christmas Price Index, their annual exercise at looking at inflation through the lens of the 12 days of Christmas and how much it would cost to give your true love all those gifts. Plus, in the market call, Nick Rach, Chief Executive Officer of the Earnings Scout, returns to the show for the first time since the pandemic.
Got a lot of free time now. You got to fill in a lot of yapping, a lot of yapping.
We don't have any free time, but we do have a lot of yapping. This is Money Life for December the 10th. I'm your host, Chuck Jaffe. Thank you for being here. This show is jam-packed because we've got all that. We had a contest running for 3 books. We'll give those away at the end of today's show, and we'll start our next contest. And with all of that coming, I have no time to talk to you here, so I'm really not going to. I'm just going to say, obviously, we have an idea of what's going to be happening with the Fed today, and we would expect that. It'll be really interesting to see what happens next. There's a lot of buckshot in that interview with Ben McMillan talking about what could happen with inflation. That's been something I've been saying for a while. Like, when does the Fed finally come out and say, hey, look, we don't need to keep it at 2%. Look at how well the things have been going. 3% would be okay. I've said that for a long time. I've asked that question for years. And basically everybody said, no, it's not going to happen. Well, maybe this is the first time that dam is starting to break. But that's a subject, well, for later today with Ben McMillan, but it's a subject for us to explore as a group, Money Life Nation, later, because again, jam-packed show. So if you've got questions, comments, suggestions, and more, you know how to reach me. It's chuck@moneylifeshow.com. And like I said, stick around to the end of the show. We'll give you another reason to send me an email with this new contest we've got going. Beyond that, this show is going to run long. I apologize for that, but better that than cutting you out from great information. So let's go. It's Amanda Agati, Ben McMillan, Nick Rach, super excited. And that starts when we talk about the PNC Christmas Price Index right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Now Money Life looks at what the survey said. Oh, it's not any usual survey here on Money Life. We could have played some holiday music or what have you, because if it is indeed the most wonderful time of the year, we may be looking at the most wonderful survey of the year. And of course, the survey said is where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. But this one, again, it's a little bit different because we are talking about the Christmas Price Index out from PNC. This is something they have done for over 40 years, where they calculate the prices of the 12 gifts from the classic song, The 12 Days of Christmas. And they do it in 2 different ways. They do it as if you bought everything once, or then they do it as if you bought the entire thing. Like every day you're buying, a partridge in a pear tree. So you're doing that times 12 kind of thing. If you want to learn more, well, pnc.com, but in our show notes, there is a direct link that will get you to all of the information on the PNC Christmas Price Index. Amanda Agati is Chief Investment Officer at PNC Asset Management. Again, pnc.com for more information. Amanda Agati, welcome back to Money Life. Happy holidays.
Happy holidays to you. It's so wonderful being able to catch up with you again this year and talk one of my favorite projects of the year, the Christmas Price Index.
Yes. And as much as we can joke about it, and we're going to have fun here, let's start with the serious side, because there is something to take away. And I'm sure you had to be fascinated by the numbers this year because, were we going to see tariffs and were we going to see whatever else? And we've got inflation generally. So is the Christmas index showing greater or lesser inflation than the rest of the world?
Oh, well, it's definitely running hot on a relative basis versus prior years. We're up about 4.5% year over year versus the BLS's headline most recent reading on CPI of 3%. So the cost of Christmas is definitely on the rise here. It's not entirely surprising considering this is a very specialty gift basket, as it were. It's a little bit of a sort of a reference to maybe the high end consumer and or what high end consumer trends have been looking like in terms of pricing over the course of this year. But there's a lot to break down in terms of this year's analysis, and I'm most fascinated but also horrified by the move in my favorite gift of all time, which is, of course, those 5 golden rings. Quite a story this year relative to past years.
Yeah. So let's talk a little bit about the entire cost for the Christmas price index and where we've gotten to, and then those 5 gold rings, because, well, frankly, nobody should be surprised at the inflation on gold.
That's right. That's right. So the price of the 12 gifts in total, so the 4.5% year over year increase, works out to be a little over 51,000. It's $51,476. Or I like to say, if you really want to make an impression on your true love this holiday season, if you buy the cumulative version, all 364 gifts and the repeated verses of the song, it's about 218,000. $543. So a big difference in terms of how much of an impression you want to make. And of course, the golden rings, yes, naturally my favorite gift. We talk about this every year, but single largest increase on a year over year basis in the index by far. Nothing comes close to it. The 5 golden rings were up 32.5% this year. I think maybe you could call it a relative bargain versus the gold commodity prices, which were up 45%. I think maybe that's a little bit of a stretch, but nevertheless, the rings didn't see the exact same increase relative to the price of gold. You could argue that perhaps jewelers are feeling a little bit of a margin squeeze, right? Because they weren't able to pass through the full input cost effect from gold commodity prices. But I think what's really interesting about it, even though we like to joke about it being, of course, my favorite gift of all time, is it's certainly a reflection of concerns out there in the global economy. The move in gold, certainly what's happening from the gold ring prices. There's a lot of concern about what the path forward may hold, persistent inflationary pressures, questions around Fed rate cuts from here. All of these things, and certainly a frostier US dollar down on a year over year basis, all made the opportunity cost of holding gold on a relative basis a bit more attractive. So there's a number of forces here, but I think this one tells us sort of an interesting, sort of holistic or consolidated macro story that investors have been wrestling with all year.
I want to point out, although you have always maintained that the gold rings were your favorite of the gifts, as one of the people behind the index, I have always questioned, but I think particularly so this year, the quality of the gold rings you are getting. Because if a gold ring is 3 to 7 ounces, which that's, I think, a standard ring, I thought, I'm looking at this going, if you got to get 5 of them, I'm expecting the price to be about 5 times, or maybe not quite 5 times the price you have on those gold rings in the index.
It's a very small, thin golden ring. How about that? So you want to stack your
You need
rings.
a couple of days to add them up, and then that you can melt them into a more substantive ring is what you're.
I mean, let's get real. Everybody wants the cumulative version of the 5 golden rings. Let's forget about all those birds and just stack up all those golden rings.
Well, speaking of the birds, that's where there was no inflation. There's a number of items that had no inflation, and it was on some of the agricultural products. Why was there nothing on the agricultural products? Why is there no inflation there on the animals?
Yeah, it's so I mean I think some of this is a function of demand, right? There and certainly supply is pretty plentiful in past years, and in sort of the midst of the pandemic we were talking about backyard farming trends and farm to table. Don't let the birds know I'm talking about it like this, but that led to a very different kind of supply and demand imbalance at that time. We've since recalibrated, and so I think the story for this year is there's just not that much demand relative to past years for, let's say, the 2 turtle doves, the 3 French hens, the 4 calling birds, and even the 7 swans. They were all flat on a year-over-year basis.
There's a dramatic difference in the cost between those items because the swans of everything are the second highest price item in there. 7 swans of swimming. Why are swans so much more expensive than your calling birds and your turtle doves, etc.?
They're bigger and they're persnicketier. How about that for a rationale for you? The 7 swans are notoriously the most volatile component of the index. And so a number of years ago, we started taking an approach, just like how the BLS would take out the volatile components of food and energy from CPI to kind of get to more of a core level. We do the same thing for the Christmas price index. But what's interesting this year, because the swans are so expensive in total and they didn't move on a year over year basis, the year over year increase in the core index is higher. It's actually 6.1%. So it's not helping true love in terms of the shopping list. That's for sure. Maybe it's a function of investors not seeing much in the way of black swan sightings this year. So you can think about it from that fun pun. Not that we're forecasting anything, but it's been pretty quiet on that front. So maybe that's good news for the market rally into the new year.
One of the interesting things is that there's been a lot of talk about what's been happening with unemployment and labor costs, et cetera. You need some labor on this, whether it's the 8 maids a milking or the 12 drummers drumming or the lords a leaping. It was the leaping lords that went up this year the most. I was a little surprised by that. I was thinking maybe it would be the 8 maids a milking, but they didn't go up at all. How is that possible at a time when we hear a lot about what's been happening with farm labor?
Yeah, sadly, the 8 maids of milking are very much tied to the minimum wage in this country. So the only times where we see an increase in that component of the index is when we see the minimum wage increase. And it's been quite a long while since we have seen that. So 8 maids of milking flat on a year over year basis. I've been sort of joking as it relates to the 10 lords that it's been the Lords of Rock kind of a year. Oasis has been the hottest ticket in town and really around the globe. And so that's a little bit of what you're seeing, I think, in real time in terms of demand for performances and experiences and concerts. That part of the services economy continues to run really hot. And this year it's the Lords that are the standout moment.
One of the other interesting things that you guys do is that you look at buying these things traditionally and then buying them over the internet. And there seems to be a dichotomy where, I think people think, oh, if I buy on the internet, it'll probably be cheaper. And in some cases it is, but in more cases, it seems like the traditional way, if you wanted to save a few bucks, would probably work, except for the things that are exotic. Why is that? Like, why do we see those discrepancies? And what does that tell us as shoppers?
Yeah, it's a great question. It is sort of an interesting and unique dynamic for the specialty gift basket that is the Christmas price index. The inflation rate on a year over year basis for all of these gifts by acquiring them online, it is lower. It's 3.1%. Remember, I said the traditional index is up about 4.5. So there is a benefit to shopping online from an inflation perspective, but the total absolute cost of shopping for these things online remains higher. It's $55,748. And despite our pleas to Amazon Prime and Jeff Bezos in particular, every year for free shipping, we never seem to get our wishes answered in that regard. And it's a little bit of tongue in cheek, of course, but the reality is the packaging and handling and shipping expenses that would go along with live birds or livestock or the other components in the index is very, very expensive. So you may get a deal by buying online, but the shipping cost is really going to get you.
Yeah, it's why people have to pay attention to that stuff because if you're not getting the free shipping, you might think you're getting the better deal. You might not be. I am distinctly not calling you old, Amanda, but you have been doing this for a few years.
A few.
Is there something you saw this year or you would have expected to see this year? You and I talk about the market in other interviews, and we will be doing that with you in the not too distant future. But the folks who were entering 2025 were thinking, this is what we're going to see. And oh, by the way, there's talk of what's going to happen with tariffs and inflation and whatever else. And we didn't see all of the impacts that we expected. On Liberation Day, everybody's expecting a lot of things that didn't come to fruition. So as you dug into this year, was there something that you were expecting that you didn't see, or something maybe unexpected that you did?
Well, two thoughts, I guess, to share on that point. So, one, as it relates to tariffs, this is a very US and domestic centric basket of goods and services. So, despite what I think some might have anticipated that, that 4.5% year over year increase might be tied to tariffs, it actually has no impact on this basket at all. This is literally just driving pricing power and inflationary pressures through a domestically produced basket of goods and services. So that's point one that I think maybe a little bit surprising for some. I mean, we know that it's a domestic basket, but to make sure that we're talking about that with eyes wide open, I think has been sort of an interesting storyline and somewhat unexpected this year. I think the other thing that stands out for me is the move in the pear tree. We always kind of refer to the pear tree as a proxy for housing costs. And believe it or not, this year, the pear tree was the second highest increase in terms of a year over year move. Now, the partridge didn't move at all, but the pear tree certainly made up for it, up 14.3%. And so I think what's really interesting there is it's very much a reflection of what we're seeing in the US housing market in total. And so even though mortgage rates have, as we like to say, fallen off the rooftop to the tune of about 100 basis points since the Fed started cutting rates, we really haven't seen that translate into a better dynamic for housing. Housing stock is still very tight. Pricing is still very high. We're short on supply, et cetera. So I think it's sort of notable and somewhat unexpected that we still are seeing this tremendous pressure in the housing market, and actually showed up in the pear tree results this year.
Amanda, it's really interesting. It's a very fun way to look at things. I appreciate you taking the time to join us. We will talk again in the new year when we get a chance to take a bigger look at the market. But thanks for your time today, and happy holidays.
Thanks so much for having me. Happy holidays.
That's Amanda Agati, the Chief Investment Officer at PNC Asset Management Group. They're online at pnc.com, and the PNC Christmas Price Index, it's linked up in our show notes, or you can find it as well if you find Amanda Agati on the guest page at moneylifeshow.com. We're just getting started on today's show. Up next, Ben McMillan, Chief Investment Officer at IDX Advisors. And then later, it'll be the market call. Nick Rach from the Earnings Scout will be here. We're living the money life. We'll be right back at it in just a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
It's time for the big interview on the December 10th edition of Money Life. Returning to the show now, Ben McMillan, Chief Investment Officer at IDX Advisors, which is online at idxadvisors.com. They spell advisors with an O at the end because, yes, in the industry, some spell it with an E, some spell it with an O. They are IDX Advisors with the O at the end, idxadvisors.com. Ben, well, he's involved in managing a number of their funds, including their Dynamic Fixed Income Fund, their Dynamic Innovation ETF, their risk-managed Bitcoin strategy. We're going to be talking precious metals with him. We're going to talk a little crypto, but we're going to start with fixed income. Ben McMillan, it's great to have you back on Money Life.
Great to be here, Chuck.
We're going to start with fixed income because here we are on a week where the Fed is looking at cutting rates. And so let's just start with your take on the Fed and what you expect to happen. Not necessarily so much this week, because I think it's pretty much baked in at this point, but because we have a cycle that's changing and a lot of information that's not out there. So what do you expect to happen now and next with interest rates? And then let's get into how that's going to impact fixed income.
Yep. So, as you said, I think, markets heavily discounting 25 basis point cut. I think that's basically in the cards. What's going to be key for this meeting, and it's really been the story for much of this year, but this meeting in particular is kind of how they message going forward. When you start to look at 2026, the Fed is combating now a slowing labor market. It's not necessarily weak, and this is what Powell said in last comments, but it's definitely slowing down. And you've got kind of a tale of two economies. If you look at the stock market, for example, it's still kind of hanging in there, but it's all driven by AI stocks. Now, of course, the Fed isn't caring about the stock market level, isn't in their mandate, but like it or not, here we are where that can't be ignored. But then you've also got inflation. Inflation is really the elephant in the room. And when you look at G7 yields, for example, they're starting to frankly explode. The bond vigilantes are starting to vote with their dollars and saying there's record amounts of debt across all G7 countries. I think, for the first time ever in the US, our net interest payments on our debt are over $1 trillion. That's starting to surpass like the entire Pentagon's defense budget. I mean, these are big numbers. And like I said, the bond vigilantes are starting to push back on that. And so the Fed it'll be very interesting to see how they message future cuts, because there's kind of two camps here. One is, all right, economy's starting to slow down. We're seeing a little bit of a risk off move in the markets. We're seeing credit spreads start to widen a little bit. Jobs market is slowing down. A lot of people out there saying there should be a preemptive 50 basis point rate cut in December. But then the other side is, and I would point to former Cleveland Fed Governor Loretta Mester, who came out earlier this week and said, listen, the Fed kind of got behind the inflation ball the first time, being slow to respond to transitory inflation. If anything, Powell is hypersensitive to inflation going forward. Now, of course, that's a whole nother story about, how much longer he's going to be around. A lot of people expect him to hand in his resignation this month. But that aside, in terms of forward-looking expectations, I think it'll be really interesting to see how he messages about the data that they're looking at, how they're thinking about that data, and specifically how they're thinking about inflation, because that's what's going to temper any kind of, forward cutting expectations. And that's what the market's going to look for.
Given what we've seen happening with yields, and it's not just in the United States. I mean, our rate cutting cycle, we're kind of late to the party compared to the rest of the world. Where in the world do you want to invest? If we're still in this cycle and our cycle is less determined, are you getting better yields someplace else? Like, is this a reason to go international?
Short answer is yes. So, emerging market debt looks very compelling right now, just frankly, because it's been beaten down for so long. And with dollar weakness, that's already kind of a tailwind for EM countries. A lot of those have commodity sensitivity too. Commodities is an asset class which has done well this year. A lot of people, ourselves included, continue to expect it to do well, even ex precious metals. We'll talk about that, but precious metals is their own beast. But, within the rate spectrum, it's interesting because ever since 2022, we've, for our entire careers, I mean, you and I are both old enough to remember where, the bond part of the 60/40 portfolio was largely just set it and forget it. People would put it into, a broad ag type ETF exposure. And then that was it, onto the equity side and maybe alternatives. Now all of a sudden in 2022, we saw two things happen. First of all, duration emerged as a really big risk. Rates backed up, and it wasn't just the credit side of fixed income that was all of a sudden presenting risks in the portfolio, it was the duration side. And then that also, the risk manifested at the same time as equity risk. So all of a sudden, not only was the 60/40 not providing the diversification benefit that a lot of people expected it to, but there was this kind of new risk or old risk brought back to the fore within fixed income, which is duration. That was one of the reasons actually, we have an ETF, which is designed to dynamically navigate different parts of the fixed income ecosystem, in large part because traditional bond benchmarks are a little bit overly simplistic in our view, ignoring huge portions of the fixed income ecosystem, like high yield or even, things like bank loans, et cetera. But then also to, more tactically navigate across the sector. So things like agency mortgages now look a little bit more compelling. The first thing I would say is be focused on duration. This is not an environment, and we're seeing it. I mean, this is not an environment where you want to reach for yield by going out the duration curve, or even in the near term, necessarily down the credit spectrum. Credit spreads have been tight for a while. We've started to see them widen a little bit. There's smart places to try and pick up some of that. There's some interesting senior secured CLO ETFs, senior secured bank loan ETFs, which we think are compelling. Agency mortgages are kind of compelling. Keep everything on the shorter end of the spectrum, we would say. So there are interesting places to find, what we would categorize as kind of safer yield, really, like I said, kind of capping duration. And then to your point, overseas, I mean, emerging market debt, both locally denominated as well as US denominated, we think have structural tailwinds, really for the next several years.
Among the tailwinds for asset classes, well, gold has been an asset class that certainly folks who have been doubting it have just watched gold defy gravity for a while here. Given what we've got with the rate cutting cycle, and where gold has been, what's next?
Gold has been very interesting. It popped up really on our radar. We never considered ourselves gold bugs, just like we never considered ourselves Bitcoin maxis, but we've kind of always appreciated their respective place within portfolios as diversifiers. And gold in particular, after COVID, I think is when we started seeing central banks really step up buying to an unprecedented level, and it hasn't really waned. And so you had that as kind of a structural shift. And as I like to say, that's not a shift along the demand curve for gold. That's a shift in the demand curve. That's a regime change. It's players like China, that, by the way, the Chinese central bank is going out of its way to obfuscate its gold buying through shell corporations and things like that. But then you also look, even little things like geopolitical premium. We're back into a world where the premium for flight to safety assets is high. We've seen that with gold. There's a geopolitical premium there. Mining output, when you start to look at the supply side, gold production has been kind of famously stagnating for years. So supply is becoming increasingly scarcer. You've got this, massive sea change in kind of the demand curve. And it's not inconceivable to think, at the beginning of last year, we said gold's going to go to $5,000 an ounce within the next 5 years at a minimum. It could be within the next 3. And people thought we were insane. And we were saying, listen, that doesn't mean you're going to all of a sudden slot in 40% of a 60-40 portfolio into gold, but it needs to be a non-zero in our mind. Now, since then, I think you've seen kind of more people appreciate that. And gold's run is not over in our minds. Now, that, again, you want to be prudent, you want to weight it appropriately. But when you start to look at what the world looks like going forward, especially with the level of debt we have and, the BRIC countries, for example, starting to, make real moves away from dollar-denominated transactions, dollar-denominated assets. There's been talk about, a global currency or a BRICS currency backed by gold. All of these are very, very powerful tailwinds for gold for the foreseeable future. So we're generally fans of gold in pretty much across all our portfolios. And it's, again, this is one now where it's not inconceivable that, within the next half a decade, gold could be sitting closer to $10,000 an ounce versus where it is today.
We can get gold closer to $10,000 an ounce without other factors that would wind up having us say the world has gone crazy?
I think the big one is just inflation. We always like to look at these kind of cost of whatever widget denominated by gold. And a lot of those have been steady over time. Even, for example, somebody, I think it might have been Sprott or a group like that, one of the gold folks said, if you go all the way back to biblical times, there's references that in ancient Roman times, for example, an ounce of gold is basically how much it costs to, dress an aristocrat. And you fast forward to today, and it's like, granted, I don't know anybody spending $4,000 on suits or things like that, but the point is, it's not that far off. It's really the dollar. It's really the fiat, particularly in the US, that has decayed relative to gold. And in fact, that was actually our most recent ETF, which I think you mentioned. We call the alternative fiat ETF, and it's risk managed exposure to gold and Bitcoin, as well as actually Ethereum and silver. And it's designed for that kind of exposure, for that kind of trade, because it's really not a trade in our minds. It's a structural change in the world, and the developed economy is just simply printing too much money. And so we would look at that and say $10,000 an ounce gold. Let's take that as kind of the hypothetical example. All that really has to happen for that is the U.S. to continue just printing too much money. And what does that look like? Well, QE, the next iteration of QE. The obvious question is, well, how and when could that happen? Especially with the Fed that's hyper, sensitive to inflation. Well, we're seeing Powell, who's going to be leaving the Fed one way or another very shortly. We're, highly likely to get a Fed governor that is, much more of a political appointee and therefore more likely to be overly dovish in the minds of many, ourselves included. I think we're getting to a world where investors or people in general are just going to have to live with a new normal level of inflation. If you look historically at kind of since the founding of America, average inflation rates have been about 4% a year. Obviously, since 2008, that's been suppressed in a ZERP environment. Now we're back to kind of, 3%, which is above the Fed's target. And by the way, the Fed has no choice but to reestablish that target higher. How and when they do that is up to them, obviously. But mark my words, you will see the Fed in the next, I think, 12 months, no later than 24 months, officially peg the target inflation rate at 3% or even higher than that. But I could easily see a state of the world in which the normal rate of inflation going forward for the next decade is more like 4 or 5% or even 6%. And especially now that we're in an era where higher inflation is the new normal, geopolitical risk is the new normal, getting to real assets is the new normal. And by the way, we haven't even talked about crypto and all of this. A lot of people talk about Bitcoin as being kind of the digital alternative to gold. And there's some nuances there. You've got to be careful. Bitcoin has a much higher beta to risk assets. And we've always kind of cautioned to keep that in mind when you're sizing it and kind of placing it in portfolios. But, like it or not, crypto in general, but Bitcoin in particular, has a capped supply, like gold. It has, naysayers notwithstanding, it has emerged as an asset class that is here to stay. It has gone mainstream. All the big banks are talking about it. We've seen all these ETFs launch. So for better or for worse, I was actually at a conference in Miami. It was a dinner at Michael Saylor's house of all places. And there was, some advisors there and some, industry participants. And I'll never forget, there was a woman there, from one of the big wirehouses. She had an RIA that was very big. And she said to me, she goes, we never really took a serious look at Bitcoin, but now with all the big, ETF companies launching Bitcoin ETFs, we know we have to figure out how to put it in our portfolios. It's no longer an if, it's a, how do we do it? And I thought that was interesting because, that represents kind of a shift in the zeitgeist that, all right, this is a new asset class, and also it's one that has, kind of the same embedded characteristics as it relates to store of value that people like relative to gold. And that's another reason we decided to pair it within our, alternative fiat ETF. But my point with bringing crypto into the conversation too is you're starting to see tokenized gold. Tether, which is one of the big, I believe the largest stablecoin provider, I believe was the largest buyer of gold in the most recent quarter. So, you're already starting to see kind of gold cross over into the digital, what they call real world assets realm. So anyway, all of that I think supports a path to $10,000 an ounce, within the next decade. That, to your point, actually, isn't that crazy, and you don't have to, jump through too many hoops or connect too many dots to get to.
Speaking of connecting dots, because I do want to come back and get a little bit more on Bitcoin and crypto, but I don't want to move away from actual precious metals without talking about silver. And the silver market also booming, but for very different reasons than gold. So what's your take there?
Yeah, silver's interesting because it's always, silver's always been different because it has actually a real industrial use case. I worked at Van Eck, earlier in my career, and, they're famous, of course, for their gold and silver and miners ETFs, and they had geologists on staffs and, experts. And I remember that was always the refrain was that, silver has this industrial use case. And what's interesting about that, and by the way, just to put numbers on it, estimates put it between, the majority of silver is actually used for industrial purposes. And so what's happened more recently is that those industrial purposes have actually been the shift in demand. And specifically, it's things like solar panels. It's the electronic vehicles. It's this whole AI data center build out, right? The same reason that copper is trading at all-time highs, because the market is realizing that we're going to need a lot of copper and a lot of silver to build out these AI data centers and the grids, the electronic grids that support these data centers. And we know that demand is robust and shows no signs of waning, as we've seen from all the semiconductor manufacturers. And so, meanwhile, China, for example, has kind of launched their whole new green initiative, which is really solar driven. That's going to be a huge user of silver. And so what you've seen in the silver market is not just speculative demand, trading in kind of paper derivatives like futures, but actually physical demand. And there's been a lot, the recent weeks, there's been a lot of concerns about just the physical supply of silver because, people have to actually use it to deliver on these industrial use cases. And so, the different exchanges there's been a lot of talk about, can you actually swap in your futures exposure for physical delivery? We're even exploring doing that in our commodities mutual funds, starting to hold silver in vaults and things like that. And so, yeah, what's interesting about silver and a little bit different from gold is it's got this, it's always had this robust industrial use case. And in this case, more recently, that has been the big driver of demand. But now also on top of it, speculative store of value. Silver has always been the cheaper cousin to gold. It's a little bit easier entry point for people that prefer physical. It's easier to buy silver coins than it is gold coins. It's just lower denominations. And so silver is a very interesting market to keep an eye on, over the next 12 months, because that is one I would not be surprised if, we see silver get into the 80s, 90s in 2026, maybe even crossing 100. I said earlier this year, I could easily see silver crossing $50 an ounce. And again, people were just like, that seems impossible. How could that possibly happen? We've seen, again, we're old enough to remember the kind of the silver squeeze in the 80s. We've seen this movie before. And by the way, if you look at the inflation adjusted all-time high price of silver from the 1980s and port that over to today's dollars, it's close to $300 an ounce, well over 200, depending on, kind of which CPI basket you use. So silver is one we're also bullish on. Again, standard caveats apply. Don't necessarily back up, the truck. You want to size it appropriately. There's precious metals now do have higher volatility profile than they used to. But it's hard to envision a state of the world in which gold and silver, for that matter, and frankly, even Bitcoin, aren't part of more portfolios as core holdings going forward.
Quickly, because we're almost out of time here, on the crypto front, as you're looking at all of this, I mean, we saw Bitcoin get up near 100,000. It's backed off hard. Its correlation with the market has been interesting. Its correlation with gold has been interesting, or maybe it's changing correlations with those things. But as you are looking at it at this point, is Bitcoin, has it at least established itself that it will be here and have some permanence no matter what we develop? Or, as you watch the other developments, do you go, yeah, there is some possibility that at some point the bottom falls out?
No, we were, I think for us, like I said, we were kind of very early in terms of offering, risk managed Bitcoin exposure to institutional clients. And even then, and, I'm talking about pre 2020, 2018, 19, even then we were saying, listen, we're not advocating for Bitcoin in a place in every portfolio. There are very high risks associated with it, market risks, but also, just kind of existential risks. I think we've turned a corner post 2020, post 2021, really, where you saw the use cases of the crypto ecosystem and really stable coins are the poster child here explode. Crypto is here to stay now, not just in terms of a speculative asset or an investment asset, but also just in terms of a use case, payments rails. You're starting to see real companies build on the blockchain for real use cases, largely payments, but that's going to start to spread into all other, kind of manners of industry. And so I think Bitcoin is absolutely here to stay. Crypto is here to stay. I actually think the boom in stable coins that we've seen is kind of the most emblematic of that. Now, the question, of course, is, all right, well, what does that look like from an asset class? How do we think about that as investors? Again, we are structurally bullish on, crypto, but Bitcoin and Ethereum in particular as asset classes going forward. Again, that's why we launched this alternative fiat ETF, with, kind of easily pairs those four, two precious metals, two crypto within a single wrapper. Because, like you said, the correlation is different. Bitcoin exhibits, kind of risk on correlations with things like the NASDAQ and kind of higher beta tech stocks. But relative to gold, its correlation is generally consistently been very low. They have kind of the same structural tailwinds. It is here to stay. That doesn't mean the risk is necessarily going to go down. Although I do think all the institutional dollars flowing into the space have lessened the risk profile a little bit. Now, again, just to caveat that, instead of, triple digit 100% annualized volatility, we're talking down into more like high beta commodities. But yeah, Bitcoin is in our minds absolutely here to stay, absolutely makes sense in most client portfolios in our mind. And it's just a reflection of kind of the new normal. If, for lack of a better term, it's kind of a different side of the same fixed income gold trade, just expressed differently.
Well, Ben, I would love to get you expressing more things on the market and the rest, but we're out of time right now. So thanks for joining me today. Happy holidays. We'll talk again in 2026.
Thanks so much, Chuck.
That's Ben McMillan, the Chief Investment Officer at IDX Advisors, idxadvisors.com, if you're looking for more information on the firm and its funds. Up next on Money Life, it's market call time. And for the first time since the pandemic, Nick Rach from the Earnings Scout will be here talking stocks. So buckle up. That's coming right after this message.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Nick Rach, Chief Executive Officer at the Earnings Scout, is here. We're talking stocks. It's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And returning to the show today for the first time in about 5 years, it's Nick Rach. If you have been around with us since the beginning of the show, Nick was on the show a lot back in 2013 when we were starting things out, etc. The Earnings Scout grew big, built its reputation, etc. He was a fan favorite from back in the day. So it's been since the pandemic times. Nick Rach, it's great to have you back on Money Life.
Oh, thanks for having me back, Chuck. I'm happy to be here.
Now, I talked about the fact that this methodology resonated with my audience in the past and that I love it because it's very clear cut, but it's a little bit different. We always start with methodology, lay it out. At the Earnings Scout, what are you scouting for? What are you doing?
Well, the Earnings Scout, we're trying to find the strengths and weaknesses within the economy, focusing on the earnings estimate revisions, and we want to play to the strengths and avoid the weaknesses as we build our portfolios. But the one thing that we do that's kind of unique, it's kind of counterintuitive for a lot of investors, is we don't care if the earnings estimates are going up or down on an absolute basis. A lot of people think earnings estimates going up equals good, going down equals bad. We always say we care more if they're getting better or worse. And the way you see that is through rate of change analysis. So we do what's called a second derivative analysis on the estimate changes. We then measure those, we analyze those, and then we rank those across 3,000 companies in our database to find out where the best parts of the economy are not only are right now, but where they're going to be over the next 12 to 18 months.
Does that mean that since you're looking at earnings and you're looking at those earnings trends, when we get a market that has some of the stuff we've seen where you don't have much breadth and you have a few things leading the way, that you will see a different kind of trend than what we're seeing just based on where the market's flowing?
The breadth is going to be more technical factors. We're focusing on the fundamentals of earnings and whether they're getting better or worse. And our whole belief is there's a lot of noise out there with data, whether it's the monetary policy, fiscal policy, tariffs, mortgage delinquencies, all those. We think people drown in data. When you get to the root of it, we think the real signal comes from the delta and the EPS expectations. Because at the end of the day, people invest politically, and we always say the market doesn't see red or blue, it sees green. And as long as the profits are getting better for particular industries, that's where shares get bid up. And that's what we're looking at. And where they're getting worse and we think they're going to weaken, that's where we try to avoid and get out of those areas in a very objective fashion too. So we're measuring those delta to those earnings expectations as the real signal and separating that from the noise.
So what do you do with an industry like AI? You have so much differentiation between the bigs and the established companies and the other stuff. Does it keep you in an industry like AI, which is doing so much stuff right now, saying, no, I don't have enough true earnings or real earnings to keep going?
Yeah, we're still very bullish on AI. At the beginning of this year, though, we have measured divergences between the estimate trends and price, and the price got out of whack for, say, an NVIDIA. But when it reset lower by almost 40% earlier in this year, now we're seeing, okay, that divergence is gone. And since April, for NVIDIA, we've measured the earnings estimates going up. And a lot of people have been questioning that, say NVIDIA maybe being the poster child of AI is in a bubble. But we're seeing its estimates not only rise, but at increasing rates. And we never see a bubble in stocks when that's occurring. We only start to see things where they become into bubble territory when we see divergences between the estimate trend and price. And a divergence can arise when the estimates start going up at decreasing rates and it's losing momentum as the price keeps going higher. Right now, we're not seeing that with NVIDIA and others related to AI. We're seeing real business improving that's continuing, and probably just more fear mongering going on in that space right now where people are calling a bubble. It may actually inflate into a bubble at some point, but it's not there yet.
Speaking of AI, one of the things that has changed in the long time that you and I have known each other is how much AI becomes a tool for guys who do what you do, who are looking at various things. Have you employed, because it wouldn't have been there when we were talking over a decade ago, have you employed AI to try to sort out, who's got the real earnings, who's got other stuff? Has it added to the layers of analysis for you?
Yes, we absolutely embrace AI, and it helps productivity. Where it helps us more with Chuck is probably analyzing conference call notes, earnings reports, where we can decipher through 500 companies very quickly now, as opposed to having to read through them all. That has really helped. The earnings algorithm that we have, we still rely on what we're doing for there. We're not trusting anything off of AI there. And the one thing we do with AI, and I tell everyone this, utilize it. It's a tool, but if you want to get to the real information, it can help weed things out for you and speed up your process, make you more productive. But ultimately, when it comes to, say, analyzing companies, there was one thing that was going on that Michael Burry's been complaining about with the hyperscalers, saying the useful life of chips for NVIDIA are too long. We go to the SEC filings on that to read the notes to the consolidated statements, as opposed to listening to what AI just tells us. But it really helps us become more productive in analyzing in large amounts of data very quickly and rapidly for us. So that has really helped our business.
Does that make it that you sometimes look back and go like, hey, 10, 15 years ago, I would have called this differently and I would have been comfortable making that call, and today I wouldn't?
We're still following the delta to the expectations, so we're not really we haven't changed anything in 20 years with our model. It's stayed the same. We're not changing it. It works. But what it's done is probably allow us to find more opportunities that we may have missed before. So I don't think we're changing anything the way we're doing. I always say the mechanics of the market haven't changed in 100 years. And every day the market's open, it's guessing and speculating what companies are going to do, not today, not yesterday, but a year from now. And so we're predicting the future, and there's expectations placed on what the company's going to earn by very smart people. And that's why us measuring the delta to those expectations, we can spot that momentum soon in the crowd. So we have not changed anything. I don't think it would change anything we're doing with AI, but it's helping us identifying opportunities we may have missed before.
Well, let's talk about the opportunities you see now. What's a poster child for the methodology, the kind of thing that this is exactly what it's going to direct you to?
One name that we particularly like is ASML. They essentially have a monopoly. The NVIDIA designs the chips. They're made at Taiwan Semiconductor on ASML machines, and they use that ultraviolet light ray technology to kind of burn into the small chips, just extremes, tiny amounts of packets of data that go on for the AI chips. That's just quite amazing. And they're the only company in the world that does that. So they essentially have no competitors. And it's a play on AI for sure, because they build the machines that's powering AI.
ASML, what's something else that stands out to you?
You got to turn on the lights for AI too. So Constellation Energy, it would be a name. Certainly an AI played, and not your father's old utility company by any means, but to power up AI, it takes a lot of power, and a lot of the hyperscalers want clean energy, and Constellation has the largest nuclear fleet in the country. And so that's the way to go to kind of turn on the lights, if you will, for powering up AI and doing all the queries and searches.
So Constellation Energy, CEG, are you finding, given where we are in the earnings cycle and given how much AI is still new, that you preferred the AI adjacent companies to the AI pure plays?
Well, certainly we think this rally is going to broaden out beyond the Mag 7. So when we look at the Magnificent Seven, the seven largest companies, have Meta in there, Alphabet, Microsoft, Amazon. Those are all companies tied to the AI. Outside of there, the 493. So we say the other companies in the S&P 500, we think are going to play catch up here at some point. They have not outperformed when it's risk on days in the market, but they're going to be sharing in the productivity gains over the several years that are being made within AI. We think those companies and even smaller cap companies should do very well going forward. But, the other play that we're looking at is AI that we also like is another name is IBM. And a lot of people, our hedge fund clients don't really think it's a sexy name, but they are doing some groundbreaking work in quantum computing that I think is, probably 5, 10, maybe 15 years out. But once we have quantum computing and the power of that, it's going to speed up the processing of computers exponentially.
And what makes you sell? Once you have the thing that the numbers are right, the story is right, the fundamentals are telling you the right things, what ultimately makes you move on? Is it more about the company, or is it more about the other ways you can deploy your money?
So we try to stay objective and just follow the math. I mean, there's a art to picking stocks where there's got to be, your gut feel and all that. But the science part that we do in terms of the math, we identify cells a lot of times with what we call an alligator jaw. When an alligator jaw opens on a stock, and we define that alligator jaw when the trends in the earnings expectations go south and they weaken for 6 months or more. So for half a year or longer while the price keeps going higher. We always say that we define that 2-quarter divergence as an alligator jaw opening up. And when the alligator jaw starts to open up, we say those jaws always close and something has to give, and it's usually the price. Those are when we start to de-risk out of a name or lighten up the load on the name. When we see that coming, when the estimates weaken, what the street expects that company to earn gets weaker and weaker, and the price keeps going up and up, that's usually a sign that we want to start scaling back on the name.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
The best is yet to come.
Well, I don't know. What we've heard is pretty good, but I know for some of you, the best part is the lightning round, and that's what we call quick and dirty. And it gives you more of a sense of what's going on because we're putting Nick Rach today to your test. Nick is the Chief Executive Officer at The Earnings Scout. Drop the and just make it earningsscout.com if you're looking for him online and you want to get more details on what The Earnings Scout does. Quick and dirty is our lightning round. To get involved directly, send your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We start today with a request from Pat in Swansea, New Hampshire. It's for Macy's, ticker symbol M.
Macy's is one I think that really shows how the rate of change works and how we can identify a winning stock, because Macy's expectations on it got so low, it was left for dead. People thought they were going to just go out of business. A lot of people thought that. So they closed the weak stores, they cut costs, and they're actually focusing on a more upscale customer through Bloomingdale's, which it ultimately owns. And when you look back, this stock, went from 34 down to 10 over the past 4 years. And that 10 was earlier this year when it went down to that level. But that's when the estimates were being cut the most at around 50%. And then the owning estimates got cut by 20%, 10%. So the estimates are actually improving. The outlooks are getting better at Macy's because the expectations in the bar got so low. So this is a name that we've been recommending to buy. I don't know that it's going to be much longer term, but this is one that we think over the next year at least should continue to go higher, in a stock that we do like.
Yes, so that trend, it got down to 10. It's now in the 20s.
Either gets on board or he gets left behind.
That trend continuing, that's a buy on Macy's, ticker symbol M. Steve in Royal Oak, Michigan wants to know about Eli Lilly. It's ticker LLY.
Yeah, Eli Lilly is a name that we think is just a core holding in your portfolio to own, particularly with demand to buy BD drugs and weight loss drugs with Zepbound and Mounjaro. We think that creates a lot of demand. They have the Alzheimer's drugs, cancer treatments, obesity in the pipeline, and it's continuing to raise earnings estimates at increasing rates. And it's pretty stable estimates that we think Eli Lilly is one that you should just own and just hold for a long term.
Sounds like the opportunity of a lifetime.
Well, you might not be holding it for a lifetime, but it is one of those opportunities you want to look at for the long haul. It's LLY, and that was a buy. Let's stay in pharmaceuticals. Ted in Cincinnati wants to know about Pfizer, PFE.
Yeah, Pfizer kind of post-COVID really has suffered at this point, but we think a lot of the expectations for, where it was were relatively high post-COVID, and it really suffered, has languished. It's maybe worth dipping your toes in. We'd prefer Eli Lilly over it, but we think you could own both names. Pfizer now at this point, it's safer because the estimate trend seems like the worst may be behind it as those expectations stabilize. So Pfizer you could own, but we would prefer you owning Lilly.
So it's a soft buy.
Buyer beware, dude.
On Pfizer, again, good company, okay stock, better stock being LLY, Eli Lilly. Sam in Woodbridge, Virginia wants to know about Pulte Group. It's PHM.
Pulte one's an interesting one. We have sort of mixed view on Pulte. We know the Fed cutting interest rates, going through cuts today, going to have, those coming, and also probably more cuts coming in 2026 when Trump appoints a new Fed chair, where he said the prerequisite for the job is going to be someone who's going to cut rates further. That should help lower mortgage rates and make affordability better for home builders to keep going and making money. But that's the problem, where affordability is very, very high. And it's an issue for buyers that can qualify. So we don't necessarily fight the Fed on here with the home builder, because rate cuts are probably coming. But the affordability makes us a little bit more lukewarm on it. So we're not saying outright sell Pulte. We're not saying outright buy Pulte either. But if you own it, we think you can hang in there at this point. But it's not an outright buy to us at this point.
So while we can all agree
there's no place like home
when it comes to Pulte Homes or Pulte Group, PHM, well, good company, not necessarily great stock. If you've got it, hold it. If not,
no money changes hands today.
Yeah, no money's changing hands today on PHM. Mm-hmm. And last, for Richard in Chula Vista, California, U.S. Bancorp, USB.
We do have a buy ranking on it. We score that pretty high in our system. The earnings outlooks are improving. The whole financial sector outlooks are improving. And some of that's coming with the rate cut cycles and yield curve expanding, which should help banks and stabilize their funding cost and help protect profits as the Fed, moves towards more cuts into 2026. Credit quality for the banks looks good. And so, we had the big loan losses earlier this year about some of the banks. People were worried about that and what that could mean. But U.S. Bank is going to benefit, has a diversified customer base, good commercial lending, solid earnings revision trends by U.S. Bank.
So we finish on a high note. That's a buy on U.S. Bancorp, USB.
Money in the bank.
Yeah, and in this case, the bank is USB. And money in the bank, well, that's what it is. If I wanted to know that we've got a good interview coming, and I see Nick Rach on our calendar. Nick, great catching up with you. Please don't stay away for 5 more years. I hope we get a chance to catch up again in 2026.
I look forward to it. Thanks for having me.
That's Nick Rach, the Chief Executive Officer at The Earnings Scout. And if you want to learn more about what they do, it is earningsscout.com. We'll come back. We'll tell you where Nick agreed or disagreed with some recent guests, and we'll set you up for tomorrow's show. Yeah, tomorrow, an absolute legend will be here on Money Life. I'll let you know who it is before we cross the finish line.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
A lot to do and no time to do it, so let's just jump straight in. I hope you liked that interview with Nick Rach. Here's where we had some crossover. He started with ASML. Peter Krull from Earth Equity Advisors was buying it back on November the 11th. Rob Spivey from Valens Research had it as his poster child on October the 9th. Garvin Jabush from Green Alpha was buying it on July the 11th. Dryden Pence, Chief Investment Officer at Pence Wealth Management, was buying it on July the 2nd. Then it was Constellation Energy, CEG. Ivana Delevska from Spear Invest had it as her poster child on October the 1st. Then there was IBM, which Jenny Harrington from Gilman Hill Asset Management had as a sell on August 6th. Garvin Jabush on July 11th said it was a buy, a sleeper play in AI, which is the same thing that Nick said. During Quick and Dirty, Eli Lilly was a buy. Joel Lippman of Altimetry liked Novo Nordisk better just on December the 4th. Daniel Ducina from Blue Chip Partners was buying Lilly on November the 21st. And Mark Dixon from Horizon Investments was buying it on November the 13th. There's your crossover. Now to our contest. And with us being so short on time, I'm not even inviting Rob Floyd in for this, though he will explain the new contest to you the rest of this week as well. So we had a contest running over the last week for 3 books. Your Future Is Now, Your Blueprint for Solving Your Retirement Puzzle by Jeffrey Panic from the December 2nd show. Face Your Financial Fears, The Simple Guide to Fixing Your Relationship with Money by Jake Cousineau, who I interviewed on December the 1st, and The Sustainable Investor from Peter Krull of Earth Equity Advisors, which we discussed back on November the 17th. To be entered, you had to guess how many pennies were in my jam-packed Ninja Pig jar. And a lot of you went a little scientific, finding out how much pennies weigh, guessing the way to the bank. Our 6 winners were all within 175 pennies from the answer. And the answer was 3,469 pennies, or $34.69. By the way, in there were 7 older wheat ear pennies, those were included. Also 6 dimes and a nickel that didn't count because they're not pennies, 1 coin that I could not recognize, and 1 German coin from before World War II, noticeable because it had a swastika on the back. Yeah. Chad in Westerville, Ohio was the closest. He guessed 3,402 pennies. He won Your Future Is Now. Mike in Maple Grove, Minnesota also won that book. Jordan in Midland, Michigan, and Philip in Southport, North Carolina won Face Your Financial Future. And the Sustainable Investor books were both going to New York to David in Woodstock and Gregory in Tully. Congratulations, everybody. We will get those books out to you, or the publishers will get them out as quickly as we can. So now let's start a contest for the Stock Traders Almanac, and this will run over the next week. Since we were just talking about my pennies, now let's talk about the rest of my change. And for me, since 2020, my change has meant everything that I get while spending cash under $10 bills. So that's all the metal plus the 1s and the 5s. And what started as an experiment has now become a way of life that I do periodically report on here on the show. And your job is now to guess how much I have saved in pocket change, which means, again, metal plus $1 and $5 bills through November year to date. Since you can't do any scientific research here, let me give you some data to chew on. My average savings for the last 5 calendar years has been $1,075.05, with a low of $941.87 in 2022 and a high the next year of $1,223.59. My smallest savings month this year was February, when I saved $59.60, which was $40 in $5 bills, 18 in singles, and $1.60 in change. My largest month this year was March, with $122.89, broken down as 50 in $5 bills, 66 in 1s, and $6.89 in change. And in 6 of the 11 months this year, I have been above $100. Not necessarily a lot above, but at least above 100. So all you got to do, send your guess for how much I've saved in the first 11 months of the year to Chuck at MoneyLifeShow.com by Monday, December 15th to enter. Please include your name and address and put contest in the subject line. Tomorrow on this show, Dan Fuss, the legendary bond fund manager, one of the greatest bond fund managers of all time. He's 90 plus years old, one of my favorite people to talk to. I'm not telling you anymore. Just be here for that. Meanwhile, if you're celebrating today, go to the library because it is Dewey Decimal System Day, or go to the bar because it's National Lager Day. My guests today were Amanda Agati, Chief Investment Officer at PNC Asset Management Group, PNC.com. It's the PNC Christmas Price Index, all linked up in our show notes. Ben McMillan, Chief Investment Officer at IDX Advisors, IDXadvisors.com. And Nick Rach of the Earnings Scout, earningsscout.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho and Stash, my dogs. Because Stash, particularly good boy with Gail, heading out to go care for Declan. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Douglas Copeland, who said, "Handmade presents are scary because they reveal that you have too much free time." Well, if you got that free time, use it productively, but don't use that time to obsess about money, because that's not the right thing to do. How do we know? Because we tell you every day that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Dude, will you just end this thing now?